Welcome back, everybody. Today we're talking about a different option strategy that we talked about in our Thursday night Discord chat that anyone can join. And a user, Investor Retire, talked about a strategy that he was doing and that he heard other people were doing, in which they use skip strike butterflies with puts to generate about 5% return every 2 weeks on options on SPY. And it seems like a really neat idea, especially if you think SPY is going to be going up in the short term. Essentially, you just need SPY not to drop like 28 points in 14 days for this strategy to work. And it feels like you're picking up pennies in front of a bulldozer, but at the same time, you're pretty far away and you're getting a 5% return. So it's very intriguing, to say the least. Now, the strategy involves doing a couple of orders for your puts here. You have to buy a put, you have to sell two puts, and you buy another put. And the idea being that SPY is just going to stay way up here, and you're only going to collect this small little credit here. If you get tested a little bit, you might make more profit, and you do have a defined max loss on this play. So essentially, it takes about $500 of buying power in order to put on this play, and you make like $25 per contract you put on. You're looking at a 5% return in about 2 weeks. And we're going to go ahead and look at this in the Thinkorswim just to show you how to set it up, because it's a very quick way to find if you could put these on. And there's people that are doing these where they set them up every Monday, Wednesday, Friday on SPY, so that they have 6 contracts essentially work, or 6 butterflies up that are making them this small credit and just making them money over the week. And then if you get really comfortable with it and you want to size up, because maybe $25 a day is not enough for you, you can put on 4, and now you make it $100 a day. Just you just size up according to your portfolio. So let's go ahead and jump into Thinkorswim on demand and take a look at this. Now we're on Thinkorswim, and we're going to look to add a simulated trade so you can see what the P&L looks like. So you go out 2 weeks, so you look for 14 days, but this is the weekend, so it only says 13. And then what you're looking for is the option that's worth about $1. So in this case, it would be the 424 strike. We'll go ahead and buy this guy. See, the delta is actually 11, so there's a 89% chance of this not going in the money. Over here, you sell the 1 strike below it, but you sell 2 of those. Let me increase that to 2. And then go down like $5 or $6, and you buy a put beyond that. So 1, 2, 3, 4, 5, 6. We'll buy this guy. So you should see you're buying 2 puts and you're selling 2 puts. When you go to the risk profile, looking at the blue number down here, you can see you're making $23, and that's in credit. And then if it moves down a little bit but doesn't breach the other strikes, you can make more money, but we're going to just assume that we only make the $23. Worst case, you lose $477. And if we pull up a calculator, we had, what was it, $23 divided by 477. And we're making almost 5% in 2 weeks by putting on this trade. And SPY would have to go down quite a bit to get down to even contest this area. So that's kind of where the people see the safety of doing this. So now that you see what that looks like, what people are doing is on every day that SPY expires or has an expiration date, they go and they sell out they set up a new contract 2 weeks out. So then every 2 weeks, you're closing one that you already had on and putting on a new one. So an example is on Monday, you sell your first one. Wednesday, you sell your second one, sell your third one, fourth, fifth, sixth. So now you have 6 of these things working in your favor, making money, probably about $25 each. So that's $150 a week. You can do more contracts if you're more comfortable with it. So if you do 2 per date, now you're making $50 each day you're doing it, so $150 a week. When you get to this date here, what you do is you end up closing your first guys out, and then you just set up your next set. And same thing here, you're closing this guy out finally, or it's going to expire worthless, and then you set up your next set that expires in 2 weeks. So that's just how that works. Is there's every date that SPY has a contract expiration date, that's when they're setting up these plays 2 weeks out and collecting that 5% over 2 weeks, essentially. And it seems pretty safe. The downfall would be if SPY drops significantly. So in the example that we did, SPY would have to drop like 28 points in 14 days in order for that play to become challenged and you need to manage it. Some things you have to think about is how will you manage that? That's something I haven't figured out yet myself. So if you have any suggestions, go ahead and leave a comment below. But this is a very interesting strategy when you feel that the market's going to be trending upwards, is to use this, because it just seems very passive. You look for when the numbers just work. It looks like you try to get to 17 to 27 cent credit, depending on volatility and stuff like that. But I don't know. I thought it was very interesting, and I thank Investor Retire for sharing it with me, and I thought I'd share it with you guys. So I hope you guys enjoyed this video. Hopefully it gave you something to think about. Whether or not the strategy is for you, that's for you to determine. We all have our own different risk tolerances. And let me know what you guys think of it, and see you guys next time.